Welcome to the deep dive, where we really try to extract the essential architecture of knowledge from your sources. Today, we're diving deep into something pretty fundamental: ambition, wealth, and systemic power. Our focus is tracing this blueprint of empire, from those 19th century guys building fortunes on steel and oil, all the way up to the architects of today's AI revolution and, well, the financiers shaping the global economy.
Exactly. And our mission really is to find the patterns, the constants. We're looking for those core tactics that let visionaries, no matter the era, build up immense wealth and control. And what often emerges is this paradox, right? The same drive that creates amazing progress. Well, it often leads straight to ethical shortcuts, or these opaque system failures we keep reading about. We're connecting the dots today: Rockefeller, Carnegie, and modern tech and finance scandals.
Yeah, it's quite a journey across time. We'll start with the, frankly, staggering speed of AI, this US-China race for data dominance. Then we jump back, look at the blueprints those first tycoons laid down, lessons that are honestly startlingly relevant now. Then we'll look at how global wealth works today, the leverage, the political side of things. And finally, yeah, we have to confront those moments when visionaries cross the line. Think Theranos, LIBOR, that kind of thing. Hubris and deception. Okay, let's unpack this, starting with this completely new landscape: AI and data.
Right. So for years, true AI felt like it was always 5 years away, didn't it? Just over the horizon. But the sources are clear. The AI revolution, it's finally here. And the engine behind it is deep learning.
And maybe we should quickly explain deep learning for everyone listening, because it's not like the old sci-fi AI. Deep learning uses these layered artificial neural networks. It works because you train it on absolutely massive amounts of data. It sort of teaches itself the patterns to recognize faces, understand speech, process financial data, you name it.
Precisely. It's turbocharged cognitive functions. That's why AI programs can now actually do better than humans at specific things. Identifying faces, speech recognition, even deciding who gets a loan. And this is the key shift. Old automation was about the hand replacing manual tasks. Deep learning automates the mind, routine cognitive work.
And the speed of it, that's what blows my mind reading these sources. Think about the Industrial Revolution turning farmers into factory workers. Agonizing, yes, but it took what, 100 years? More? Societies had time to adjust, sort of. AI is just exponentially faster.
The predictions are, well, they're disruptive, let's put it that way. Based on current trends, AI could technically replace something like 40 to 50% of U.S. jobs within 15 years. That capability is almost here.
40 to 50%, that's hard to even wrap your head around. And okay, the actual job losses might lag a bit, maybe another decade, but the sources say the disruption will be very real, very large, and coming soon. And they stress it's not just economic. The psychological hit. Losing your professional identity, that's huge.
Which throws us straight into this geopolitical contest, doesn't it? U.S. versus China, AI dominance. Building that kind of economy needs four things, apparently.
Right.
Those gladiator entrepreneurs, tons of data, skilled AI engineers, and government backing.
And the sources point out China has this unique edge in one area: data. Their online and offline worlds are, as one source puts it, rubbing shoulders in a unique way. Creates this incredibly rich, real-world datascape. Think about WeChat Pay. Use it for everything, right? Street food, bills, traffic tickets, bike rentals.
Yeah, that seamless integration means all this data, transactional, financial, behavioral platforms, it all gets funneled into a few giant national platforms. They've basically turned urban life into this massive data collection engine. And that's been key, helping their tech giants catch up fast to U.S. firms and revenue and market cap.
But there's a counterpoint in one source. China has the volume, sure. But the U.S. apparently still holds a commanding lead in the underlying tech, like 90-10 advantage, one source estimates. That's rooted in the core model innovation, like transformer models for large language systems. Doesn't matter how much data you have if you lack that cutting-edge architecture, right?
But that's why it's still a race. The near-term forecast, say next 5 years, it gives the U.S. and China even odds on leading in self-driving cars. That's a huge market. And China might even have an edge in hardware stuff, like autonomous drones. So the balance is definitely shifting in certain areas.
This whole competition, though, it sounds really worrying for developing countries. There's this real fear it'll just widen the gap massively. The AI haves and have-nots.
Oh, it's structurally terrifying, potentially. Think about it. Historically, how did developing countries kickstart growth? Low-wage factory labor, that was the path. But now, if manufacturing and services get automated by smart machines and the AI superpowers, that whole path could just disappear. The ladder from agrarian to industrial built on cheap labor might be pulled up.
Wow. Okay, zooming out one last time here. This intense AI race, it actually links back to basic science, doesn't it? The sources mention things like CRISPR, that virus-fighting system in bacteria.
Right, and AI is now the tool speeding up the application of science, like CRISPR. It's used heavily in genetics, protein folding, drug discovery, slashing the time for breakthroughs. So this AI superpower race, it's directly tied to who leads in biotech. It just proves again that basic, curiosity-driven research, even into obscure biology, has massive economic and health implications down the line.
That idea that controlling a unique resource or knowledge gives you immense power, that's exactly what the 19th century tycoons got. Only their resource was efficiency, logistics, and maybe exploiting loopholes.
Yeah.
Here's where it gets really interesting. We tend to see these industrial titans as just production geniuses, but they're empires, built on a pretty consistent blueprint. Grab regulatory control, integrate everything vertically, and exploit crises. Let's start with Carnegie, regulatory capture.
Okay, Carnegie. Yes, he built the most efficient steel plant. Absolutely. Genius-level efficiency. Gave him the power to undersell everyone domestically. But that edge was massively helped by politics.
You mean the tariff, right? That huge 28 a ton tariff on British steel. $28 back then.
Staggering, yeah. It was basically a government handout. It meant foreign steel just couldn't compete on price, period. So Carnegie had this protected playground in the U.S. His empire wasn't just industrial smarts. It was smarts amplified by government protection, weaponized trade policy.
Does it kind of challenge the whole free market story we usually tell about America back then? Sounds more like a rigged game.
It definitely complicates the picture of free enterprise. The sources suggest these guys wanted a profitable equilibrium, which often meant crushing real competition. And look at Carnegie during downturns, crisis exploitation. When a depression hit, banks stopped lending. But Carnegie, he had cash. He borrowed more from Scotland and told his manager, Frick, basically, take every order, slash prices, make sure nobody else could even think about restarting production.
Wow. So he didn't just survive the crisis, he used it as a weapon. Drive prices below cost for rivals who were strapped for cash. Calculated move to grab market share permanently.
Exactly. Now, shift to Cornelius Vanderbilt, master of contradiction, monopoly builder, publicly. Oh, he loved unfettered trade and unrestrained competition. That was his line.
The sheer nerve. Because right after saying that, he goes and engineers a total monopoly over the California steamship lines. Essential routes back then. Sounds like his idea of unfettered trade was, sure, trade freely, as long as I own the only way to do it.
He honestly didn't see a problem. He figured if he was good enough to beat everyone else, well, the monopoly was his reward, earned, you know? And staying on top meant being ready, always, to financially crush anyone who dared challenge him.
This whole era, the sources call it the birth pains of a truly national economy. These early railroads, they were built locally, right, for local needs. Now they had to somehow link up into a national system.
And that forced linkage created massive systemic risks. Imagine one railroad owner getting mad at another and just closing his tracks to their trains. Boom. Commerce could just freeze up on the East Coast. It showed how absolutely critical it was to centralize control over that infrastructure. Someone had to be in charge.
Which brings us perfectly to John D. Rockefeller Sr., the master of vertical integration. And his drive might have been deeply personal, tied to his childhood, this psychodrama with his father, Bill.
Yeah, Bill Rockefeller, apparently a bit of a character, a traveling banker type.
Yeah.
He had this habit of calling in loans on young John D. at the worst possible times, just to test him. John D. apparently remembered feeling angry beneath the surface. That early chaos seems to have fueled his obsession with order.
And that obsession translated directly into his strategy for oil. The early oil industry was wild, chaotic. Rockefeller wanted control, so he built his system to profit whether there was too much oil or too little. Market swings didn't hurt him like they hurt everyone else.
His weapon, the United Pipeline System. It was so efficient, so widespread, it basically became the central processor for all the oil in the region. He got to the point where he was apparently mocking the actual oil producers, calling them ingrates and malcontents whose oil was worthless without his pipelines. Pipelines connected to 20,000 wells. He owned the network.
That's it right there, the parallel. Rockefeller's pipelines were like the physical app store of the 19th century. Producers had to use his system, and he set the terms, controlled the value chain. What's fascinating is how this pattern repeats. The real power isn't just making the thing, it's controlling the delivery, the network, the rules.
Exactly. That focus on infrastructure control. It's exactly what we see in modern digital ecosystems, controlling information and market access.
Okay, so let's shift from 19th century physical pipes to today's hyper-globalized, leveraged world. The sources are clear. The rise of the global super rich, driven by globalization and the tech revolution.
And those drivers create this powerful feedback loop, don't they? More money means more political clout. Money, politics, ideas. They all reinforce each other. It's both the cause and the result of this elite rising. Wealth gets concentrated, and then that wealth is used to shape the rules of the game.
And a big part of the modern financial playbook, especially in private equity, is that crisis exploitation again, using leverage when others are weak, just like Carnegie, really.
The historical data backs this up. Investments made during downturns consistently outperform. Think buyouts in 91, 92, 2001, 2002. Average returns near 30%, according to the sources, much higher than other years. Timing is crucial. Liquidity is king.
And firms like Blackstone are masters at this. They raise billions when times are good, and then they just sit on it, patiently. Then, when the economy tanks, they swoop in, buy distressed companies cheap. Fire sale prices. Blackstone supposedly went into 2010 with, what, $29 billion ready to deploy, just waiting for bargains.
And the key mechanism for juicing those returns, massive leverage. Look at the Freescale buyout example. Debt went from maybe $830 million before the buyout to $9.4 billion afterwards, just exploded. And that huge debt isn't just risk. Those massive interest payments, nearly $800 million a year in that case, become a giant tax deduction for the buyers. It effectively subsidizes the purchase and rockets up the return on their actual equity investment.
That kind of balance sheet engineering is one tool. But modern tech giants, they've got another trick, the negative operating cycle.
Ah, yes. This is absolutely key to understanding how companies like Amazon got so dominant. Normally, a business buys stuff, holds it, sells it, then waits to get paid, ties up cash. Amazon flipped it. They get paid by you, the customer, immediately. But they pay their supplier maybe 30, 60, even 90 days later.
So they're constantly using their supplier's money to run their business. It's like free financing.
Pretty much. It generates this massive cash float they can reinvest aggressively, build warehouses, cut prices, launch new services, all without relying heavily on outside investors. It's a self-funding engine of dominance built purely on financial architecture.
This intense concentration of capital, whether through leverage or operating cycles, brings us right to the politics of inequality. U.S. wage inequality post-1970 exploded, and it's super concentrated at the very, very top. Top 1%, even the top 0.1%.
Which really challenges that classic economic idea of marginal productivity, that you get paid what your work is worth. Because if productivity gains were the whole story, shouldn't the benefits be spread a bit more evenly?
Yeah, the sources point out U.S. inequality today is higher than apartheid South Africa or recent past India with low literacy rates. That's stark.
It forces you to look at the mechanisms. Things like carried interest loopholes for fund managers, aggressive tax sheltering, control over financial infrastructure. These allow wealth to pile up in ways that seem disconnected from just producing more stuff. It makes you ask, does a free market, structured like this, really lead to the best outcome for capital and labor?
And this concentrated wealth translates directly into political power. In the U.S., you have the Koch brothers funding Americans for prosperity. It wasn't just donations. They built a whole grassroots movement pushing for certain economic policies.
And that provided, as one source puts it, crucial leverage for someone like Mitch McConnell in the Senate. That funding infrastructure helped keep the party caucus unified on key votes. Money buys organization, cohesion, and political muscle.
You see a similar playbook adapted locally in Asia. The Asian godfathers using guanxi, these deep personal ties with political elites.
Yeah, and it's way beyond just lobbying. It's systemic. Constant entertaining, lavish gifts, jets, yachts, homes abroad, plus offering paid board positions to family members of ruling parties or royal families. Lim Gotong's casino empire in Malaysia, for example, relied heavily on relationships with retired police chiefs and political figures. Access and influence weren't just helpful, they were basically required to get and keep the lucrative licenses.
Okay, so we see empires built on strategy, leverage, political skill, but the pressure cooker of modern business, the demand for insane growth, that pressure often pushes leaders over the line into outright deception. Let's talk Theranos. What a story.
Theranos is just a chilling case study. Silicon Valley chaos, secrecy, but taken to a criminal extreme. What's really telling is how some insiders just saw the mess and the secrecy as normal. Oh, all tech startups are like this. That normalization created this incredible dangerous space where the story mattered more than the actual results.
And the story was driven by Elizabeth Holmes. No real medical or science background, and a habit of not listening to experienced people. People inside were skeptical, deeply skeptical. But that skepticism was just crushed by intimidation.
The fear inside that company. The lab director, Alan, got so worried he'd be blamed for the faulty tech that he forwarded tons of his own emails with Sunny Balwani to his personal account just for protection. Theranos found out, threatened to sue him immediately for breaking confidentiality. Keep quiet or else.
They basically ran a scorched earth campaign against anyone who questioned them, inside or out. It got truly absurd. Like when executives refused to say how many tests were actually run on their Edison device, the miracle machine. Why? Trade secret. A lawyer literally argued, well, if it's not magic, it must be new tech. Denial at all costs.
And they kept managing the perception right to the end. The sources mentioned Theranos working with a clinic. Theranos basically provide other lab services to counter bad press about their own inaccurate tests. Always spin, never admit the core problem.
Okay, moving from fake tech to fake numbers. The LIBOR scandal. Gaming the entire global financial system. LIBOR was huge, right? This benchmark rate affecting trillions in loans, mortgages, everything, based on banks' estimates of borrowing costs.
Yeah, and the internal dynamic was messy.
Yeah.
You had traders like Tom Hayes, blunt, maybe rude, who openly admitted manipulating the rate. His old legal strategy seemed to hinge on getting charged by the UK's SFO, hoping for a better deal than in the US. And the manipulation itself. Hard to spot from the outside because it wasn't always huge moves in one direction. Some days they'd nudge LIBOR up, other days down, just enough to benefit their trading positions.
And the banks basically made it easy, didn't they? The definition of LIBOR was vague, no real rules on how staff should set the rate.
It was practically an invitation to game the system. And Hayes, among others, certainly did. What's odd is how open Hayes apparently was about his positions. Usually, after disasters like long-term capital management, traders learned to keep quiet, because rivals could figure out your strategy and trade against you if you were failing. But here, it seemed like casual, open manipulation in some cases.
Looking back further to the 80s junk bond era, Michael Milken at Drexel, another kind of structural deception. Milken had this way of hiding credit problems, right? If a big company whose bonds Drexel sold was about to default,
He wouldn't let it happen, not publicly. He'd orchestrate an exchange offer, restructure the debt, often piling more leverage onto the already struggling company. It was like a pyramid scheme, using new debt to paper over the cracks in the old debt. It kept Drexel's default stats looking artificially amazing until the whole thing inevitably started to crumble under its own weight.
and it involved straight-up illegal acts. Milken telling Ivan Boteski to secretly buy a huge chunk of Fishbox stock while guaranteeing Boteski wouldn't lose money. That's market manipulation 101.
Right. Then Boheski hits the 10% ownership trigger, has to file a 13D disclosure with the SEC.
Which is supposed to declare your intentions if you buy a big stake.
Exactly. And Boheski filed a false one, didn't mention Milken's involvement, didn't mention the guarantee against losses, proving the whole deal was built on hiding the truth from the market. Criminal conspiracy.
This kind of ruthless drive, maybe impatience, persists today in tech leadership. Think Elon Musk, firing an engineer late on a Saturday night, yelling, "You're an idiot, get the hell out," over a robot arm alignment. That's raw impatience driving things.
And then you have Jeff Bezos. His ruthlessness is more strategic, maybe calculated. He saw the iPod crush the music business faster than expected. His takeaway, it is far better to cannibalize yourself than have someone else do it. He looked at Kodak. They had digital camera tech early, but couldn't risk their film profits. And look what happened. Bezos learned that lesson. What's just fascinating here is it's the same cycle, isn't it? Ambitious leaders push boundaries, sometimes way outside the rules. Today's world, with its complex finance LIBOR, LBOs, and its information fog, Theranos just provides new playing fields, new arenas for those old human impulses, the hunger for dominance, personal and corporate.
That really ties it together. We've gone from algorithms to arbitrage, future tech to past manipulations, and the core dynamics seem constant. Disruption happens, wealth gets made, but ethics are always, always tested.
Yeah, the central theme that keeps popping up is this deep tension. It's not just capital versus labor. It's also transformative progress versus the consolidation of power. That's the tug of war. Whether it's Carnegie using tariffs, Rockefeller owning pipelines, Amazon mastering cash flow, or modern finance finding tax loopholes. Real lasting wealth often comes from controlling the underlying system, the infrastructure, the rules, the network everyone else needs.
So what does this all mean?
Well, we've seen how empires get built. Genius, sure. Leverage, absolutely. And ruthlessness, often. Now think about the AI revolution, its sheer speed. The potential, according to some sources, to replace nearly half of all jobs relatively soon. Does this moment lead to an even greater concentration of power than we've ever seen before, locking out huge parts of the world? Or could this level of disruption finally force us to fundamentally rethink how we structure and distribute economic rewards? That's the big question.
Definitely something to chew on. Think about that as you process the knowledge from this deep dive. We'll see you next time.